The digital revolution has brought about unprecedented opportunities for global commerce. Yet, it has also opened up new avenues for tax avoidance and evasion. Multinational corporations and wealthy individuals can easily shift profits and assets across borders, often exploiting legal loopholes and regulatory gaps. To combat this growing problem, researchers and policymakers are turning to innovative tools to enhance tax transparency and ensure a level playing field. One such tool is the tax accounting equation, or TAE. The TAE represents a novel approach to detecting and deterring tax avoidance in the digital age. By integrating financial accounting data with tax-specific information, the TAE provides a comprehensive framework for analyzing corporate tax behavior. This equation allows us to move beyond traditional accounting metrics and delve into the complex interplay of factors that influence a company's tax liability. In essence, the TAE acts as a magnifying glass, revealing subtle shifts in accounting practices that may indicate attempts to minimize tax payments. The TAE is not simply an abstract concept confined to academic journals. It has real-world implications for tax authorities, policymakers, and investors alike. For tax authorities, the TAE offers a powerful new weapon in the fight against tax avoidance. By identifying suspicious accounting patterns, tax agencies can more effectively target audits and investigations, ensuring that companies pay their fair share. Policymakers can use insights gleaned from the TAE to craft more robust tax laws and regulations, closing loopholes that allow for profit shifting and base erosion. The development of the TAE marks a significant step forward in the ongoing battle against corporate tax avoidance. As we delve deeper into the intricacies of the digital economy, tools like the TAE will become increasingly vital in safeguarding the integrity of our tax systems and ensuring a more equitable distribution of the tax burden. At its core, the TAE builds upon the fundamental accounting equation but incorporates elements specifically relevant to taxation. The basic accounting equation states that assets equal liabilities plus equity. This foundational principle provides a snapshot of a company's financial position at a given point in time. The TAE expands upon this framework by integrating tax-sensitive elements, such as deferred tax assets and liabilities. Deferred tax assets represent taxes paid or carried forward to future periods, which can be offset against future tax liabilities. Conversely, deferred tax liabilities reflect taxes that will eventually be due on income earned in the current period. By incorporating these tax-specific components, the TAE provides a more nuanced view of a company's tax position than traditional accounting metrics. The TAE also considers the impact of permanent differences and temporary differences. Permanent differences are transactions that are treated differently for accounting and tax purposes and will never reverse. Temporary differences, on the other hand, are transactions that are recognized in different periods for accounting and tax purposes but will eventually converge. By explicitly accounting for these differences, the TAE allows us to isolate the factors driving discrepancies between a company's book income and its taxable income. Through the incorporation of these tax-sensitive elements, the TAE enables us to move beyond superficial analyses of corporate tax behavior. We can begin to unravel the complex web of accounting choices and tax strategies employed by multinational corporations. By understanding the mechanics of the TAE, we can develop a more sophisticated understanding of how companies navigate the global tax landscape. The rise of the digital economy has made it increasingly difficult to track and tax corporate profits. Digital goods and services can be easily transferred across borders, making it challenging for tax authorities to determine where value is created and consequently where taxes should be paid. This has led to a proliferation of sophisticated tax avoidance strategies, with revenue reclassification emerging as a particularly prevalent tactic. Revenue reclassification involves manipulating accounting rules to shift profits from high-tax jurisdictions to low-tax or no-tax havens. This is often achieved by exploiting transfer pricing regulations, which govern the prices that multinational corporations charge for goods and services traded between their subsidiaries. By artificially inflating the costs of goods or services sourced from low-tax subsidiaries, companies can reduce their reported profits in high-tax countries and shift income to tax-advantaged locations. Consider, for example, a multinational technology company headquartered in a high-tax country with a subsidiary in a low-tax jurisdiction. This company could sell its products through its low-tax subsidiary, even if the subsidiary plays a minimal role in the value chain. By setting a low transfer price for the products sold to the subsidiary, the parent company can shift a significant portion of its profits to the low-tax jurisdiction, thereby reducing its overall tax liability. The TAE can help us identify instances of revenue reclassification by highlighting discrepancies between a company's reported accounting profits and its effective tax rate. If a company consistently reports high profits but pays a disproportionately low effective tax rate, it could be a red flag for revenue reclassification or other tax avoidance schemes. By analyzing changes in deferred tax assets and liabilities, the TAE can also detect shifts in profit recognition patterns that may indicate attempts to minimize tax payments. Developing the tax accounting equation involved a multifaceted approach that combined empirical analysis with sophisticated modeling techniques. To test the robustness of the TAE, I employed a variety of econometric methods, including regression analysis and Monte Carlo simulations. These techniques allowed me to isolate the impact of specific factors on corporate tax behavior and to assess the sensitivity of my findings to different assumptions. Monte Carlo simulations proved to be particularly useful in understanding the potential implications of the TAE for tax enforcement. These simulations involve running thousands of iterations of a model, each with slightly different input parameters, to generate a range of possible outcomes. By applying Monte Carlo simulations to a large dataset of corporate tax returns, I was able to estimate the potential revenue impact of different tax policy changes and to identify the types of companies most likely to engage in aggressive tax avoidance. Of course, no model is perfect, and the TAE is no exception. One limitation is the availability of granular standardized data on corporate tax behavior. While publicly traded companies are required to disclose significant financial information, including tax payments, data on privately held companies is often more difficult to obtain. This lack of comprehensive data can make it challenging to fully assess the prevalence and impact of tax avoidance across all types of businesses. To address this limitation, I employed a variety of data imputation techniques to fill in missing data points and to ensure the representativeness of my sample. Additionally, I conducted sensitivity analyses to assess the robustness of my findings to different assumptions about the distribution of missing data. These efforts help mitigate the potential biases introduced by data limitations and strengthen the overall validity of my research.